Sellers are pulling homes off the market at the fastest pace since 2020. And if you read that headline and think we're headed back to pandemic chaos, you're reading it wrong. Here's what's actually happening. I'm Daniel. This is American Affordability. Let's go ahead and dig into the data. Here's what's really going on. A lot of sellers are frustrated, sellers of standard residential homes. They're frustrated. They listed their home. They waited weeks or months. They didn't get the offers they were hoping for. And rather than lower the price, they pulled the listing. According to Redfin, 5.8% of all home listings were pulled off the market in April, which is tied for the highest level of delistings since March of 2020. Now that sounds dramatic until you flip it around and realize that 94% of listings stayed active. So let's keep some perspective here. The more important question is not how many homes were removed, it's why they're being removed. For years, sellers had basically all the leverage. Buyers were offering above asking price, waiving inspections, rushing into purchases because they were terrified that prices would keep climbing forever. And a lot of homeowners got used to the idea that any property would sell fast no matter what. Today, that's just not the reality anymore. Buyers now know that they have choices. They know they have negotiating power. And in most parts of the country right now, there's no reason to offer over asking. There's no reason to waive inspections, and there's definitely no reason to panic buy because you're afraid that the inventory will vanish overnight. So these days are new, and those days are largely behind us. Homes are taking longer to sell. Affordability is still really strained, and a lot of sellers are being forced to confront something that they haven't had to deal with in years, which is that the market has changed. Some respond by lowering their price, others pull the listing and tell themselves they'll come back later with better photos or a new agent or a different description. But honestly, in most cases, the marketing isn't the problem. The price is the problem. And here's where it gets really interesting, because while sellers are pulling listings, inventory is actually continuing to rise. According to Redfin, there are nearly 1.5 million homes listed for sale right now. That's the highest we've seen in years. And it's roughly 300,000 more homes than buyers were dealing with back in 2021. So the overall trend is clear. Inventory keeps moving higher. And when inventory rises faster than demand, homes sit. And that's exactly what's happening. So there's a lot of sellers that just aren't used to it. For years now, homes practically sold themselves. Today, unless a property is priced right or offers something that's genuinely unique, it might sit for weeks or months before getting a serious offer. And that's creating frustration all across the market. If you're finding this breakdown useful, hit the subscribe button. I do this every week, and the next one might be even more relevant to your situation. We always are going to talk about homes and the real estate market on this channel. Now, here's something that's buried deeper in the same Redfin report. Sellers are actually relisting homes at the highest rate since 2020. Think about that. A lot of the homeowners who pulled their properties off the market last year are now coming back and trying again. About 2.5% of homes that were previously listed are now being relisted. Why? Because eventually reality catches up. The house still hasn't sold. Life hasn't changed, and many sellers are realizing they need to adjust their expectations. According to Redfin agents, a growing number of these folks are coming back with more realistic pricing and a genuine willingness to get a deal done. And that's one of the biggest shifts that we're seeing right now. Redfin also just launched something called early access, which I actually think is a really smart idea. It lets sellers test the market before officially listing. Basically get some feedback on pricing and also buyer interest without accumulating days on the market. Because once you hit like that 45 to 60 days on the market range, buyers start asking, what's wrong with this place? And in most cases, the answer is simple. The price is too high. Okay, so let's take a look at what Realtor.com is seeing, because their data tells a very similar story. They open their report by talking about inflation, which matters more to housing than people sometimes realize. Inflation affects mortgage rates, consumer confidence, household budgets, and ultimately whether someone can even qualify for a mortgage. So April's CPI came in at 3.8%, and some forecasts are suggesting that May, once the report comes out, could be even higher, which is around 4.2%. So if that happens, we'll be looking at inflation accelerating at a pace we haven't seen now since 2022. Of course, that's not good news for purchasing power, which is already one of the biggest problems in this market. So here's what Realtor.com found. Listing prices have now fallen year over year for 7 consecutive months. The median listing price is down by 2.4%, which is the largest annual decline in their records going back to 2017. Now, before anyone gets too excited, a 2.4% drop doesn't erase the massive appreciation that we saw during the pandemic. A lot of markets were up 40, 50, and even 60%, just like here in the Tampa Bay area in just a few years. But what it does tell us is that sellers are becoming more realistic, and that is a meaningful change. Interestingly, homes going under contract have actually increased for 6 straight months. And that might sound surprising given everything we've been talking about, but it makes sense when you look closer. In some markets, prices have finally fallen enough to bring buyers back in, which is great. There are some areas around the country where prices are down more than 20% from their peak. So that's great. For buyers who were completely priced during the pandemic frenzy, those corrections are creating real opportunities for purchasing. And honestly, that's how a healthy market is supposed to work. You know, if prices rise too much and demand weakens, then, prices adjust, buyers return. That's a normal cycle. That's Econ 101. The problem is that we're still dealing with a cost burden that simply just didn't exist to this degree only a few years ago. Mortgage rates are still elevated. Insurance costs keep climbing. Property taxes keep going up. Maintenance costs are rising. Wages haven't kept pace with what it actually costs to own a home. So even with some price declines, housing costs are still one of the biggest obstacles out there. And one trend that's getting, almost no attention is the rise in contract cancellations. So more homes are going under contract, yes, but more deals are also falling apart before they actually close. So that tells us that people are still being cautious. They're negotiating harder. They're walking away more readily, and they're no longer willing to just push through and overpay to get a property. And that's a huge difference from the pandemic years when buyers felt enormous pressure to close no matter what. Today, if the inspection turns up problems or the financing stops making sense, then buyers are much more willing to walk. So at the same time, price per square foot is down 2.5% year over year, which is the largest annual decline that Realtor.com has on record, which is kind of crazy. For buyers, I mean, that's good news. For sellers, they're getting obviously more realistic in negotiating. Their leverage keeps shifting away from sellers and towards buyers. So every month that passes seems to reinforce that trend now. We'll just kind of have to see how it goes now in the future months. So when you break it down by region, listing prices declined across all the major regions of the country. So that matters because parts of the Midwest and the Northeast have been surprisingly resilient compared to places like Florida, Texas, Arizona, and also parts of the West Coast. But even in those stronger markets, listing prices are now coming down. And there's an important distinction to keep in mind here. We're talking about listing prices, not necessarily final sale prices. The fact that sellers are entering the market with lower expectations than before is, it's really a psychological shift. Price per square foot is declining in 35 of the 50 biggest metro areas. Some of the biggest drops, which Austin, they were down 8.3%, Memphis went down 5.9%, Buffalo down 5.8%, Indianapolis down 5%. Those aren't rounding errors. Those are meaningful declines that show markets slowly working their way back towards something more affordable, which again, we know for buyers is a great thing. One other thing worth mentioning, there's actually a pretty notable discrepancy between Redfin and Realtor.com's inventory numbers. Realtor.com estimates about 1.08 million active listings. Redfin puts it at nearly 1.5 million. So that's a 400,000 listing difference. And nobody seems entirely sure why the numbers diverge that much. But here's what both companies agree on. Inventory is increasing, relistings are increasing, and delistings are increasing, all at the same time. That's a pretty unusual combination, and it highlights just how much uncertainty is baked into this market right now. The median home is currently spending about 52 days on the market, and that's only 1 day better than a year ago. So not much has changed on that front. Homes are, they're still taking dramatically longer to sell than they did during the pandemic. And honestly, that's probably healthier. Buyers should be able to take their time making the largest financial decision of their lives. And nobody should be feeling pressured to be signing paperwork within 48 hours. But while conditions are clearly improving for buyers, the math still doesn't work for a huge portion of the population. And that brings us to the real issue. It's the reason so many homes still aren't selling. So let's talk about that. One of the questions I keep hearing is whether home ownership still builds wealth. And when I say hearing, I mean reading online and forums on Reddit and all that. And look, for decades, Americans have viewed owning a home as one of the safest and most reliable ways to build long-term financial security. In a lot of ways, that's still true. Homeownership can build equity, it can create stability, it can and encourage, disciplined saving in a way that renting often really doesn't. But I think it's worth being honest that the environment has changed. The era of double-digit annual appreciation is probably over. During the pandemic, a lot of markets saw gains, like I said, 40, 50, 60% in just a few years. And that was extraordinary. And it's not likely to become the norm again anytime soon. Most major forecasts are projecting much slower growth going forward. Moody's and several other firms are estimating something around 2.1% annual appreciation between 2026 and 2035. So that's much closer to historical norms. And frankly, that's probably healthier for everyone. Rapid appreciation is great if you already own a home, but it creates enormous problems for the next generation of buyers. And that's exactly what we've been living through. So as of late 2025, about 81% of Americans still believe that owning a home is a safe way to build wealth. I get it. For generations, it's been one of the most reliable ways for ordinary families to build financial stability. The problem today isn't whether homeownership can build wealth. The problem is that access to homeownership has become such a serious barrier that a lot of people can't even get in the door. I mean, here's a specific example. If you buy a $500,000 home with 10% down at a 6.5% mortgage rate, the projections suggest that you could accumulate around $234,000 in housing wealth over 10 years, right? So, I mean, that sounds great. Most people would take that deal. But here's the catch. To comfortably afford that home in the first place, you'd need a household income of roughly $170,000 a year, based on Zillow's affordability calculator. And the assumptions behind that number weren't even that extreme. We're talking a $50,000 down payment, a 30-year mortgage, a 6.5% rate, about $1,000 a month in other debt, standard homeowners insurance, no HOA. Even with those fairly typical assumptions, you need $170,000 a year. And here's the thing, a $500,000 home is not considered luxury housing in a lot of America anymore. In some cities, that's just an average family home. Yet only about 20 to 22% of American households earn $170,000 or more. And that's roughly the top 10 to 15% of income earners. So when people ask why homes are sitting longer, why sellers are frustrated, why listings are being pulled, why owners are relisting at lower prices, this is your answer. The buyer pool is limited. There just aren't enough households who can afford today's prices. The math doesn't work for most people. And that is the core problem facing this housing market right now. It's not a lack of desire. Millions of Americans would love to buy a home. The issue is that the numbers simply don't add up. Now, here's a part of the conversation that almost never gets enough attention. People love talking about how much wealth homeowners build. You'll hear it all the time. I bought it for this, I sold it for that, look how much I made. But that's only half the story. What usually gets left out are the actual costs of owning a home. According to Bankrate, the average homeowner spends about $24,000 per year beyond the mortgage. Not $2,400, $24,000 a year beyond the mortgage. That covers, property taxes, homeowners insurance, utilities, maintenance, repairs, upgrades, landscaping, all the unexpected stuff that comes with owning a home. So over 10 years, that adds up to roughly $240,000. Now go back to the earlier example. The projected housing wealth gain was $234,000 over 10 years. So those two numbers are almost identical. And that is kind of the point here. Home ownership absolutely can build wealth, but it also consumes wealth. And too many people only look at one side of the equation. The real financial picture is almost always more complicated than I bought it for X and sold it for Y. There's also the capital gains, the capital gains tax issue, which a lot of homeowners don't think about until it's too late. So if your home's appreciation exceeds the applicable exemption limits, you may owe taxes on some of those gains. You can potentially reduce that liability by adding eligible improvements and major repairs to your cost basis, but that requires documentation. You got to have those receipts, records, tracking renovations over years or even decades. And honestly, most homeowners aren't keeping 20 years of organized records in a filing cabinet somewhere. As a result, a lot of people end up paying more taxes than they had to. Okay, so let's shift a little bit here. Now let's talk about something specifically important for anyone in Florida. And I'm going to talk about this because obviously I live in Florida, and so this is interesting to me. But there's a proposed constitutional amendment that could be on the ballot here in November. And as I say this, I think they just passed it the other day, so it will be on the ballot. So if it does pass, it would be pretty significant change for property owners here. Right now, Florida's homestead exemption sits at $50,000. So under this proposal, that exemption would jump to $150,000 starting in 2027, and then it would increase again to $250,000 starting in 2028. So after that, it would adjust annually for inflation. So that's a really substantial increase. There's one key limitation. The expanded exemption would really only apply to the non-school portion of your property taxes. So there's school taxes that would stay the same, but even with that carve out, we're talking about real savings for a lot of homeowners. The amendment that they're proposing also includes some protections for non-homesteaded properties. Non-permanent Florida residents who own property here could receive limited tax protections during their first several years of ownership, with a path to full homestead benefits once they establish Florida residency and meet the requirements. So I'll be honest, that part surprised me a little. It's a broader set of benefits than I expected to see in this proposal. The amendment would also require the local governments, your municipal governments, to prioritize property tax revenue for essential services, which is a pretty big change. So they have to prioritize then law enforcement, fire protection, emergency medical services, transportation infrastructure, road and bridge maintenance, stormwater projects, flood control, natural resource management, things like that. So those would all have to be prioritized in the municipal level. And there's another change that I think is really meaningful for a lot of property owners. Right now, assessed values on non-homesteaded properties can increase by as much as 10% per year. So under the proposal, that cap would drop to 5%. So for anyone who owns investment property or a vacation home or any non-primary residence in Florida, that alone could provide some real protection against runaway tax bills, which we're seeing not only in Florida, but all across the United States. So the amendment will still have to be approved by voters here in November to become law, but it points to something bigger, that property taxes have become really a growing concern for homeowners, like I said, all across the US. Even people who own their homes outright are still facing rising costs every single year. And that's a big part of why so many people are feeling squeezed even after the mortgage is gone. The expenses don't stop when the mortgage is paid off. Taxes keep going, insurance keeps going, maintenance keeps going. That's the reality that a lot of homeowners are living with right now. So where does all of this leave us? The housing market has changed. That much is, I would say, clear. Inventory is rising, relistings are rising, delistings are rising, like we said. Listing prices are falling, price per square foot is falling in most major markets. Homes are taking longer to sell, and buyers have more negotiating power than they've had in years. So those are real, meaningful shifts. But the cost burden is still the biggest obstacle. Even as prices soften, I mean, homeownership remains pretty expensive relative to what most people earn. And that's why we're in this unusual situation where inventory keeps climbing, but demand can't keep up. The market is getting better for buyers, but a lot of buyers still can't afford to participate. And until that changes in a meaningful way, we're probably going to keep seeing the same pattern. More inventory, longer selling times, more realistic pricing, and more sellers slowly accepting that the housing market that they remember from a few years ago just doesn't exist anymore. I think that about wraps it up. Thanks so much for watching. If you got something out of today's video, please take just a second, hit the like button, and subscribe. It really does help the channel and lets me keep making content about housing, inflation, retirement, and all the affordability challenges that people are dealing with today. And drop a comment below. I genuinely love to hear what's happening in your local market. Are homes sitting longer? Are sellers cutting prices? Or is your area still holding strong? Let me know. Thanks again, and I'll see you in the next one.